Can a company recognize revenue as soon as it signs a contract? Not necessarily. That's exactly what IFRS 15 explains. IFRS 15 provides a single framework for recognizing revenue from contracts with customers. The key principle is simple. Recognize revenue when control of the promised goods or services transfers to the customer. IFRS 15 follows 5 steps. First, identify the contract. Second, identify the performance obligations. Third, determine the transaction price. Fourth, allocate that price to each obligation. Finally, recognize revenue when each performance obligation is satisfied. The focus isn't when the customer pays, it's when the company fulfills its promise by transferring control of the goods or services. Next, we'll explain IFRS 16 and how lease accounting changed for businesses around the world. Subscribe to AI Finance Hub and continue your IFRS journey.